the Australian Tax Office collected over $15 billion in income tax last financial year that it should never have received. Not because people cheated, because people did not know the rules. And the rules, right now in 2026, have never been more loaded in your favor if you know where to look. Here's the uncomfortable truth. The Australian tax system is not designed to be simple. It is designed to reward the people who understand it and quietly take more from the people who don't. And most Australians, hard-working, decent people paying their taxes on time every single year, are handing over thousands of dollars they are legally entitled to keep. Today, I am breaking down 5 tax loopholes that are completely legal, hiding inside the system right now, and that your employer, your payroll department, and honestly, most accountants will never bring up unless you ask the exact right question. Let's start with the first one, and it is hiding inside your super.
Start by knowing your actual number. Add up every asset you own. Super balance, shares, savings, property value. Subtract every debt. Mortgage, car loan, credit cards. That number is your net worth. Write it down. Most Australians have never done this, and you cannot fix what you have never measured. Next, look at what your super is actually doing. From the 1st of July 2026, payday super kicks in. Your employer must now pay your super at the same time as your wages, landing in your fund within 7 business days. That means compounding starts faster. It also means you can see immediately if something is off. Log into MyGov this week and check. Then look at your concessional contributions. The cap rises to $32,500 from the 1st of July 2026. Every dollar you salary sacrifice into super is taxed at 15% instead of your marginal rate. If you are on 37% or 45%, that gap is enormous. The money you have been funneling into an offset account could be doing far more tax-efficient work inside super.
And if you have had years where you did not hit the cap, the carry-forward rule means those unused amounts do not disappear. As long as your total super balance is under $500,000, you can reach back up to 5 years and make a lump sum concessional contribution. Sell an investment. Receive a bonus. Use that carry forward and turn a big income year into a big tax saving. Finally, diversify what you own beyond bricks. Global ETFs, Australian shares with franking credits, a properly structured portfolio that actually pays you something while you wait. Because retirement is not the day you sell your house, it is the day you stop needing to. The Australians who get this right are not the ones who own the biggest home on the street. They are the ones who looked at their home as one piece of a larger puzzle. They maxed their super. They invested outside property. They built assets that generate income, not just value on paper. Your home gave you stability. Now it is time to build the rest.
It is the Medicare levy surcharge escape. If you earn above $93,000 as a single, and you do not hold private hospital cover, you are already paying a 1% to 1.5% surcharge on top of the standard Medicare levy. On a $120,000 income, that is up to $1,800 a year in extra tax. A basic private hospital policy can cost as little as $1,200 a year. The maths is brutal and obvious. You are paying more in surcharge than the insurance actually costs. And yet millions of Australians in this income bracket are still paying the surcharge every single year without realizing it. Check your income, check your cover, and fix this before the end of the financial year. And the 5th loophole is the one that will matter most in the next 3 to 5 years. With the May 2026 federal budget changing the capital gains tax rules from the 1st of July 2027, the window to restructure how you hold long-term investments is closing fast. From that date, the 50% CGT discount is being replaced with cost-based indexation and a 30% discount cap on assets held more than 12 months. for high-income earners with large share portfolios or investment properties. The difference between acting before and after that date could be tens of thousands of dollars. The strategy here is not panic selling. It is planning. Review which assets are sitting on large, unrealized gains. Talk to a licensed financial advisor and a good accountant now, before the window shuts. The tax you plan for is always smaller than the tax that surprises you. So here is what you can do today. Pull up your last payslip and check whether you are salary sacrificing anything into Super. If not, start the conversation with your HR department this week. Log into MyGov and check your carry-forward concessional balance. Check your income against the Medicare levy surcharge threshold. And if you own assets with large gains, book a conversation with an advisor before the end of 2026. The Australians who keep more of what they earn are not smarter. They are not better at maths. They just stopped assuming the system was working in their favor and started checking for themselves. If this opened your eyes to money you are currently leaving on the table, hit the like button and subscribe so you do not miss the next one. I will see you there.